Good morning and welcome to Bazaar Morning Call. I am Anuj, with me, Sonia and Prashant. As usual, Sonia and Prashant, hi, good morning. I woke up this morning, got a bit of a deja vu kind of a feeling. The inflation fear is back. Brent crude is surging once again. You're seeing what's happening on some of the LME metals. Brent crude, in fact, is now approaching 124, and most of the commodities are on a rampage. The dollar index, once again, making a move towards that 99 mark, 98.77 to be precise, and the Nifty once again fell from congestion zone. The SGX Nifty is indicating a bit of a gap down, not by a lot, but will be interesting to see. 17,197 is what we have. Weekly options expiry as well today, of course. So let's see how things go. Sonia, hi.
Hi, good morning, Anuj. Good morning, Prashant. The only thing is that these are the known devils, right? I mean, this is something that the market has perhaps been grappling with for a while. So the three large concerns, of course, it's been escalating by the day. So Brent is now at $123 a barrel. You have the Fed officials saying that there's a 50 basis points rate hike that's coming. And you have the Ukraine war that's escalating. There are, of course, talks with the NATO, with the European Union, etc. But Anuj, all these are known. This is something the market has been dealing with for a while. I mean, you saw the weak handover from Wall Street as well. For our own markets, it's been really up and down for the last many days, just reacting to the headline numbers. But the flows are not so bad. I mean, FIs continue to buy in this market. They bought about 500 crores yesterday and barely any selling from DII. So the question is this, right? The market has seen a fair amount of rebound despite all this volatility. Do you think that now investors may perhaps, or traders may perhaps use a dip to buy into the market because of these fears being digested?
Yeah, I think you're right in that sense, Sonia. But look, the market rally happened when Brent crude had collapsed from that 130 mark to 99. So in that sense, we're back to 124. Obviously, the same news, last time we were at 123, the market was at 16,000 something, right? We're at 17,200 now. So in that sense, the market's also moved on, but still, it's a negative. My basic point is, and I'll ask, I'll ask Prashant's opinion as well on that, is the global short squeeze done? Because, we were part of a big global short covering rally. Is that done now? I think for now, 17,500 looks like a ceiling for the market. That's something where you also have 66% retracement zone of that entire rally, fall from the January highs. 200-day moving average is at 17,000. So I think we are still in a range of 17,000 to 17,500. My sense, Sonia, is that the big financials are showing some tiredness. And in that sense, today's Kotak block deal, by the way, will also have ramifications, because that would mean large FI selling, right? If you see this week, HDFC, Kotak, Axis, they're down between 2 to 3%. Consumption names are seeing big decline once again. You look at this week's top Nifty losers. You have Britannia, Lever, Asian Paints and Nestle. What's that representing? That's inflation, simple as that. Inflation and the concerns on that, concerns on margins, and that's clearly something which is you want to keep an eye on. I think today's index to track is the Bank Nifty. Yesterday, ICICI ADR was down quite a bit. Today, Kotak will start on a bit of a downtick, though market knew about it, or at least had a bit of a hint about it. But the Bank Nifty has been repeatedly rejecting the 200-day moving average of 36,700. It's possible that now you test the 20-day moving average, 35,360. It's entirely possible you test that. With the way dollar index is moving and the way crude is moving, I would want to watch the fund flow data once again to see if that short squeeze is over and now you start to see selling once again. But that's something that we'll find out. But Prashant, good morning. What's the global signal looking like?
I mean, the problem is with so much macro-wise is happening, but to distill it all down to daily moves is so hard, right? I mean, it's, for example, yield curve inversion, fears of stagflation in the US, right? I mean, how does all of that impact price movement on any single day? That is a really tough one. It's a really tough nut to crack. It's tougher, of course, if you are trading day to day as well. Let me just quickly run you through the setup that is what happened overnight. I mean, of course, oil is the big story. It's popped up again, and we'll have more details on it. So very, very quickly, it's added $20, $25, right, from the lows. And it's now to the upper end, which was about 135, closer to the upper end as compared to the lower end, which was just under $100 a barrel or so. Yields suddenly all came down. So this is US Treasury yields I'm talking about. Actually, not just US, but global yields as well. So you look at the US 10-year, 5-year, you look at the 30-year, for example, it's under 2.5%. That was a big reversal. You look at the German bond, You look at, all across the board, you had yields which came off. This to many, of course, signals, and these are nominal rates I'm talking about, signals fears of growth, underlying growth being under pressure, right? So, but the point is, whenever it yanks up, many in the market do believe that the market is adjusting to the Fed, which will have to move much higher in terms of pushing rates up because they're behind the curve. So it's kind of a catch-22 situation for equity markets trying to interpret what's happening in the bond markets at this point in time. But I think I've said this before, the way all of this, at least on an immediate basis, translates to a market like India is through oil prices. So that's something we need to watch. And I mean, you only have to listen to companies we've spoken with very recently in the last couple of days to get a sense of the fact that it is actually pinching, right? We've spoken with auto companies, we've spoken with auto analysts, we've spoken with agri players, Adani Wilmar, for example, we've spoken with the cement company, JK Cement, all of them telling us the same thing, that, it's not hunky-dory. They may be able to, they will try and pass it on, but how much pushback there will be from the consumer, will it impact volumes? Those are real questions which I think will continue to play on the minds of investors. Sonia.
Absolutely. And I think, it's showing up in the stocks, right?
Yeah.
If you slice through sectors and you see the performance this year, whether it's Ultratech Cement, whether it's Britannia, whether it's Shree Cement, Nestle India, all these stocks are down 15-20% this year already.
Yeah.
So it's reflecting in the stocks the kind of pain that these companies are going to see on the margin front. And perhaps that's an overarching theme that we're going to discuss on our show today. But without wasting any time, the SGX Nifty is indicating that the start will once again be in the red. So let's get you some opinion. On the equity side, first up, Mahesh Nandurkar of Jefferies says that the Nifty is up 11% over the last 12 months, despite foreign selling of $28 billion in the secondary market. Thanks to strong domestic buying, the strength of the domestic buying has increased gradually since 2014. Retail flows can sustain as households save over $700 billion annually, and equity flows are just 5% of annual savings. While market correction due to rate hikes and premium valuations remains a risk, domestic buying should likely smoothen the declines.
Okay, let's get you some money market views as well then. Pramit Brahmabhat of Veracity says the rupee may trade sideways due to offsetting cues. FIs have started to buy in cash market, but oil continues to move higher. The range for the day is seen between 76.10 to 76.40.
Okay, and the rupee has seen a fair amount of correction in the last many days, now trading above that 76 mark. On the bond front, Dhaval Dalal of Edelweiss says sovereign bonds continue to trade nervously amidst persistent geopolitical risk and inverted US Treasury yield curve. Investors have priced in hawkish policy actions by developed market central banks. That said, the RBI is expected to stay put on rates in April. He expects the 10-year bond yield to trade in a range of 6.8 to 6.95% in the near term.
All right, those are views coming across asset